All right, so because of travel yesterday, I wasn't able to get a market outlook done last night as I was out of town from early afternoon on after my class yesterday. So I'm putting this together here at the market open this morning just so everybody can have it and watch it throughout the day today before we take a look at it here later tonight. On the surface, there wasn't that big of a move yesterday, but under the surface, there's some very interesting patterns, and there were some big moves in some areas in the market. So I'll break those down, what those patterns are that we've actually seen before, and so we'll talk about the precedent of those patterns, what their significance are, what the implications are, and talk about what we expect to see from the markets here coming out of the Thanksgiving break, potentially into the beginning of 2025. We do have our Black Friday sale going on. It's live on our site right now. If you go to marketscholars.com, there's a red bar across the top of our site with information on that sale. It's our biggest sale of the year. It works out, it's 20% off our premium subscription. It works out to being about $75 a month. Our normal access to our site that doesn't have all the premium tools is about $129 a month. So it's a big difference. And that's why it's our most popular sales, where we tend to get most of our subscriptions. So you can also see it if you follow me on Twitter in the pinned tweet that I have at the top of my David Settle 42. In the reply to that tweet is information as well on that Black Friday sale where you can go find it. Our trade idea of the day is on a stock that really broke out in a nice good breakout pattern in a very important sector of the market. So let's go ahead and get started. Today is Tuesday, November 26, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join us at MarketScholars.com for free. Remember, we do have our Black Friday sale going on right now for our premium subscription. Follow us on Twitter for more content between the videos and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at the trades we've done in previous Market Outlooks and see whether we should actually stay in them or get out of them. We actually closed out a trade in our last live video. We also put on the current day's trade before the market closes. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down and click that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, everybody, let's take a look at the S&P 500 here with the market forecast indicators. You can see we had another day, seventh day in a row now to the upside, coming off of the pre-expiration low point where we dived down with the bearish near-term low point down to the 30-day moving average. Of course, the intermediate line is now crossed back above the 80th percentile, has barely crossed above its market sentiment line by about 0.06 of a point here. The momentum line coming out of bearish territory, but still in the lower half of the chart. Again, we're small ranges. It's going to be hard for the momentum line to really get back up, considering unless we get a bigger range and close right at the high of the day. But the 7-day rally, of course, keeps the near-term line up above the 80th percentile as well. So we're not in any real threat yet of a near-term decline. Probably won't get one now, as the markets will probably end up being really sideways and really small ranges for the next couple of days. Well, today and then Friday, right? Unless, again, Friday we had, Friday 2021, we had, a really bearish half day. But for the most part, we rarely have any major movements. So we're probably not going to have any movements here the rest of the week going into the first week of December, right, where we have our jobs report and then the inflation report the week after that, and then the FOMC meeting the week before the Christmas holiday. So we should be fine. Eventually we'll get a near-term decline where the near-term line drops down, but like I said, most likely won't start now this week if we're not going to have anything here the first 2 days of the week, and we're still going to stay higher. So good move. Of course, the NASDAQ 100 looks very similar because it's almost the same index. The S&P is up to new highs. The NASDAQ is obviously not, and it's still not even really close to that. The intermediate line is not above the 80th percentile, nor is it above market sentiment line. And because of the really small ranges here in the NASDAQ, Now you got your near-term line falling. Now it's still above the intermediate line, hasn't crossed below it yet, but you can kind of see how we're not getting the leadership from the NASDAQ 100 like we typically do, considering the market caps and the disparities, the cap weighting disparities that you have in the S&P that are pretty much largely skewed towards the stocks in the NASDAQ 100, the biggest stocks in the NASDAQ 100. If you look at the Dow Jones Industrial Average, you'll see again easily a new high. So much better move here than what you're even seeing in the S&P, almost at the 45,000 now. Of course, the intermediate line crossing above market sentiment, crossing above the 80th percentile. Very strong near-term run all the way up, coming off of a pretty bearish near-term decline, but obviously now a very strong near-term rally above the 90th percentile. 5-day winning streak here on the Dows. We had 2 down days after the expiration. 5-day winning streak and looking very strong there. And then your Russell 2000, which is more correlated with the Dow than it is the Russell, a little different, right? So we pulled back a little bit here. We closed at 242 on a Monday. Yesterday we closed about 18 points lower almost. That brought the near-term line below the intermediate line. And the momentum line down into oversold levels. Now this is an intermediate confirmation signal because of the oversold momentum line and the bullish, the dark green shading that we have on the chart because of the intermediate lines rising. Ideally you want the intermediate line above 80, and ideally you want the near-term line at least below 40. So we don't have either one of those yet, which means we might, at least according to this, might have another down day on the Russell. Again, depends upon how bullish we are in the large caps. And how much it pulls the Russell up with it. But right now the Russell is, at least yesterday was the weak link for the markets on a short-term level. Of course, it was the only one that was actually down yesterday. Let's take a look at the weekly chart for the S&P 500. As you can see, the nice, good, strong bullish candle, the 91st percentile, the green dot. The PPO is rising. We're in the 91st percentile of the last 3 years. If I zoom out to like the last 5 years, not quite. We're in the 84th percentile there because of how strongly bullish we were in 2021. But still pretty strongly bullish here. And like I said, a good strong candle. It's the size of the candle is above the moving average. That's probably going to be temporary, like it is. When you have the first surge, everything else is temporary after that. You can kind of see it here too as well, and it looks like we're getting one of these moves, right, where you're back above the moving average, and it typically only lasts a week or two before you get another transition candle, and so we'll see how that plays out here. But at least it is a higher close and a higher high, and we're closing above last week's high, so very bullish from that perspective. Looking at a 3 green arrow chart, obviously you have 3 green arrows across the board except for on the Qs. You're not quite there yet, but we're close. Remember, this has been the laggard because it's not even close to a new all-time high yet, and all the other indexes have all gotten new highs, new 52-week highs at least. You take a look at the 2-line version of the S&P 500, and you can see we are above the 8-day. We're above the value area. It's clearly bullish here. All lines are pointing higher. Everyone's on top of the other. Good trend right now on the markets. Taking a look at some of the other oscillators, you are still above 30 on the positive indicator, below 20 on the negative, so it's bringing the ADX higher. But again, we're not even trending yet, so that kind of goes to show, the last couple of intermediate runs that we've had. See, we're still on this intermediate rally, and it never really ended here. So the last couple of intermediate runs that we had, you can see the ADX got above 25 at the beginning, and then stayed above 25 the whole time until it ended, right? And then we had our pullback. On this intermediate rally, it took a while for the ADX to get above 25. Eventually it did at the end, and then went parabolic, right? It got all the way above 40 before we had our intermediate decline. So here we are now. The ADX didn't get above 25 until here late. We had this little pullback, and now we're back below 20. Again, so and you can see on this intermediate rally, same thing. The intermediate line didn't get above 25 until late, and then it went parabolic, right? And then we had our intermediate decline. So kind of a little different intermediate rally than what we've seen the past few. It's a lot weaker from that regard. But we've seen at least the 2 of the last 3 ended with parabolic moves. The third one had one in the beginning we haven't had a parabolic move yet. The highest the ADX has gotten is just under 30. So it kind of, again, goes to show just how weak this particular intermediate rally has been, even though it is obviously up to all-time highs, and you know, especially not just how weak it's been, but how weak it is now, despite its maturity. Here, looking at the RSI and the CCI, again, still at bullish levels, still above 60, still well above 0, and actually a little bit above 100 there on the CCI. Looking at the Ichimoku cloud, we are back. So we did end the trend. So the trend started over here, coming off this low. We did get up to a few times up to weak trends, then it ended. Then we had a weak trend again, and then it ended. And then we had a weak trend turn into an intermediate strength trend, actually turned into a mature trend, got above 5, got above 80, and then it ended. And then now we've started a couple of times with weak trends. It's still weak. You see, it's got to get above these dotted lines. This dotted line here, the same dotted lines that you can see. The small dotted line would be equivalent to getting above 50 down here. So we are above that on both lines, but we're not above the heavy dotted lines, which would be intermediate strength trend, and of course the thicker dotted lines would be the mature trend, right? So you know, it's still going. The trend is still going. It's obviously a lot weaker, and we'll see if we end up with a parabolic move going into the end of the year, or not, right? Or if we end up getting our reset by the end of the year. Taking a look at the Bollinger Bands and the Keltner channels, we are flirting with that upper quartile. Strong bandwidth is rising again, so the momentum is picking up to the upside, well outside of the Keltner channels. We are not closing above the Keltner channel, so that you kind of need that to maintain some good strength. As you can see, when you don't get above the Keltner channel, your momentum starts to wane. Even though you're going up, your momentum is waning until you have that pullback there. So we do need to get above that Keltner channel and get at least above the 75th percentile, if not closer to the upper band. And so obviously we're not there yet on either one of those. Again, reflecting the lack of strength in the bullish. Obviously, it doesn't mean that we're not bullish. It just reflects the lack of strength that we're seeing there in this bullish move. Taking a look at the intraday move, we did get a higher high, we did get a higher low. We actually closed above yesterday's high barely and closed right at the high. So the high, well, came really close to closing right at the high. We got above 600 at the very end of the day, and then barely finished above 600 by the end of the day there. So nice surge at the end, ended up barely closing actually below yesterday's high. But still very strong intraday. You can see we got a new, we're still at 100 there. We're almost getting down to 0 now, which means the new low is going to come off the chart. But it also means that we're going to really jump up on this. You can see we're not very big on the width of this 4-week channel. But after a few more days, so this was yesterday, so this will be today, this will be Friday, and this will be Monday. So by Tuesday of next week, the low point will come all the way up to here, right? So this, we'll hit 0, but then it will jump up because the low point will hit to this point. And unless we have a significantly new high point, the size of the channel here is going to drop again to extreme lows. So again, reflecting kind of this lack of strength and this bullish move that we're getting right now. And you'll see that as well in the volumes and the trading ranges. This is very typical of a Thanksgiving week. The volume was actually about average at 45 million, even though that's a very, very low average. The ATR are very low. So when you look at it on this chart, you can see the volume. Like I said, the volume is really low. Discount this drop right here because this was the pre-election drop. Obviously, not a lot of volume pre-election because nobody wants to take a big position pre-election. So discount that. So you can kind of see that this level here, 45 million or so, is the low point for the average right now. If you look at the 2 years, you can see that's a significantly low level. And you'll also see that too, really, in this money flow index. It is up to new highs, pretty strong new highs here. In fact, if I were to go all the way back out to 20, let's see, we have to go out more than 3 years now. This is crazy how fast time flies. You can see now we are getting close to about the same level on a money flow basis that we were at the high point, right? At the high point in January of 2022, we've now almost reached the same level. On that day, this would be 1/4. We closed that day at 385, 385, whatever that is, right? That value there, 385. Right now, we are at, well, we are just a little bit above that of where we were. Right, it actually peaked here at 441. It was actually on 1229, and obviously the peak is over here at 532. So we're not anywhere close to that, but we are right at the same level, or just barely has eclipsed the same money flow level on an absolute basis of where we were at the high point of 2022 before we started that correction. So it kind of goes to show how much volume there was on the decline, and then how much there's been of a rebound. Now, that's not normal. Typically, by the time the price reaches the prior level, so like in this case, you had a decline and then you reached back up about right here on price, you got back up to those old highs. You can also see by that level, the money flow also got back up to its previous highs. That's typical. So this pattern where we dropped on heavy volume, the volume, like we rallied here on really light volume because the volume actually went lower to lower lows here and this banking crisis. And then we started to really increase on very, very weak volume. Very weak volume. To the point now where we're way up here, well past, 477 up to 600, and yet the volume is just barely now reaching. And you can see the volume here on the oscillator is already peaked and potentially rolling over after getting a few surges here in volume to get the trend started, and now we're unable. So again, kind of like what we saw at the end of this trend and at the end of this trend, where you get the surges to kind of get the trend started, to come out of this convergence, to get the trend started, to have that second leg higher, trend started, second leg higher. But then when you get that surge that doesn't quite get up there at the end, then we typically falter at that point. And it looks like a similar pattern developing right now, that we're not able to get another surge here, despite the absolute level going up as high as it is. So that's kind of, and like I said, the ATR is way down, right? So now it's back below 90.9. It's well below 1%, which is good. And this is actually a good level. Getting below 0.8 is now extreme. So at least we're not to that point yet. We're okay. But we're probably going to get to that point by the end of the week, because the ranges today and probably Friday are going to be very, very low for the S&P pre-holiday and post-holiday there. If you take a look at the VIX, you can see it is below 15, below the 80, all the way down the 85% mark. Remember, this is the extreme low for the VIX this year, this calendar year. It's usually 80% the extreme low, but since the 2024 started, it looks like 85% has been the extreme. Obviously, we're below 15. We are also below 90% or 90 on the VVIX. Here's the VVIX there, and if you take a look at this, this has been the lows for the last little bit, at least, for the VVIX, right? So getting below 90 and staying there, getting below 15 and staying there, getting below the 200-day moving average on the VIX, its own 200-day moving average, and staying there is very good. Getting to it or just a little bit below it has been low points. So we'll see if coming out of Thanksgiving, if there's an increase in volatility because we're at the low points, or do we really start to really slow down and grind because we even go a little bit further below those lows and stay below those lows, those key low levels right now on the volatility index. All right, now let's take a look at what's driving the price action here today. So let's come to the sector, or let's see the asset class comparison chart here, and just look at, or at least what happened yesterday here. Let's go to November. Let's see, that's 24. Let's do this. November yesterday, and a 5-minute chart. So there's your equities. Remember, IWM was so bullish the day before on yields falling and the dollar and gold was, everything was just in such a huge decline, big moves. Well, the IWM didn't drop a whole lot. Obviously didn't lose everything that it got on Monday, but it came back down to where the Qs are, right? So the Qs, which really underperformed IWM on Monday, because again, the drop of the dollar, the drop in yields, the drop in commodities, all very bullish, right? That's a three-headed monster. That's a good monster, right? Now it pulled back today. Bonds are still up quite a bit this in the past 2 days. Commodities are still down near their lows of the past 2 days. Gold obviously is still down as well. The dollar is still down near its lows. So there wasn't really that significant of a rebound in those other asset classes. But IWM still pulled back regardless, right? So it kind of goes to show, that move. Here's the current move that we're seeing. This is the move yesterday. This is the current move in the dollar for today. We'll talk more about in tonight's market outlook. But going into this move, you can see yesterday the dollar pulled back a little off of its highs, but still stayed well above the 8-day moving average. If you look at the 10-year yield, which you remember the 10-year yield had that big drop last week. And then we bounced up yesterday, right? So, and here we are. This is today so far, and we're down today. But yesterday we had bounced back up, so we held the bull tag. We didn't bounce back above the highs of the bull tag, but you can see the intermediate lines coming down. We'll talk more about this crossover. This is not necessarily the best crossover, but you can kind of see that we bounced back up yesterday. So we're okay. And then finally commodities, which also had that big decline. I'll take a look at commodities here. Also had that big decline on Monday, yesterday we kind of bounced back up, right? Kind of finished flat from one day to the next, 22.24, but we had bounced back up and before falling intraday and still finishing below the moving averages and still pointed lower. And we opened up down today before rallying. You can kind of see, remember, the biggest component of that is crude oil and what happened on crude oil on Monday, and then still holding that. So, that's the three-headed monster. When those three things go down, we saw what happened on IWM. It really rallied, and then we saw it show up in this relative, this ratio, right, of QQQ relative to IWM. Let's go to a 1-year chart. And you can see it really dropped on Monday, big time drop, but then it bounced yesterday, but still is well below these averages. I mean, we are, like, the Qs are really starting to lag. Like, we are trending, we're below the 200-day moving average. Over here we got below the 200-day moving average, but we didn't stay there long enough to really get all these averages down below it too. The 8 and 17-day crossed. By the time the 30 crossed, we were actually above the 200-day moving average. So the 30 eventually came back up above and flirted with it, but eventually came back up above. The 50-day finally broke through down here too. But then, the stock immediately bounced. The ratio, immediately bounced, and your 50 came right back above the 200 briefly. But now they're all below the 200. The 8 and 17 is below the 30. The 30 is crossed below the 50. They're both below the 200 and falling. There is a clear, decisive trend. In fact, we're about to cross below zero on the long-term PPO, which generally, like right now, the correlation is negative. But this is not the normal correlation. As you can see, if I were to zoom out and look at the weekly version of this, this is a 3-month correlation. So if I look at the 60, the weekly version of that same time frame, it is weakening, but it's generally positive correlation. So there have been times where we've had moves to the downside, and most notably post-election, though we were already negative going into that election, and then the reopening trade. And so here we are again post another election where the Russell 2000 has the potential of outperforming, but you have to remember too, now the difference between now and even 2016 is the sector disparities are a lot bigger now than they were then, in terms of how much more you can see the ratios doubled now, more than double now than it was then. The CAPE ratio, the valuations are a lot higher now than they were in 2016. You can see the CAPE ratio there almost at 38.5 now. So extreme, it's extreme level. Going into 2021, this is about the peak that we got to, was 38.5. So it's an extreme, this is an extreme mark for valuation. So it's a little different scenario than we were in 2016, where you can see this is where the CAPE ratio was then, coming out of that election. And like I said, the sector disparities, when you look at how much weighting there is in the S&P 500, is bigger now. I mean, you have 13.5% between the top two companies. The top four companies are well over, the top three companies, well over 20%, well over 20%. That's a tremendous move up to the upside on those three companies there. And you can see Apple, you add Amazon into there, you're about 25% of the market wrapped up in the top four companies in the S&P 500. That was not the case in 2016. So here we go, 23.5% in those top four. And then you add on Meta, and then you add on Alphabet, both Alphabets, and then you add on Tesla. And again, you're at over 30% from the Mag 7, almost a third of the index from 7 companies. Again, that was not the case in this. Actually, yeah. So you can see Berkshire would be the next highest. So that was not the case in 2016. We did not have the top 7 companies making up over 30% of the market. So it's a different scenario now than it was then, to have the IWM outperforming the Qs in the market, and the S&P still staying bullish, right? So essentially the 493 companies, which is, if you look at RSP, the equal weighted index, relative to SPY. Let's look at the other way around. SPY relative to RSP. So this is the equal weighted index. You can see when SPY is outperforming RSP, and then the S&P is usually bullish. And you can see that hasn't been the case here lately. So let's go back to a daily chart and zoom in. We are breaking below the 200-day moving average of what is typically a very positively correlated ratio with the S&P just in general. So that's a breakdown that's not generally bullish, and you can see they're still pretty strong on the long-term PPO. So in 2020, so the reopening trade, you can see we broke down there, and then let me zoom out to 2016 so you can see that as well. The post-election right there. So there's that post-election move. Again, you can see it was briefly, it was negative all that year going into, the ratio was negative with the S&P 500. And obviously now it's not, it's pretty strongly positive. But here we are breaking the 200-day again, which, generally speaking is not bullish for the markets, especially considering how high the ratio is. In the last 10 years, it's coming off its highest levels. In the last 20 years, it's also coming off its highest levels that we had, at the very lows of the financial crisis and at the lows of the COVID. We're right back at those same levels again. So again, very heavily weighted towards a very small number of stocks, and then now we're breaking down. So that usually when you're resetting those sector disparities, it's not, again, unless you are reopening the economy, which we did here, it's not generally seen as a bullish thing for the market. Or in this case, in 2013, another time we broke the 200-day and traded well below that level. We were QE3, right? We had QE3 all 2013, 2014, boosting the markets with a lot of liquidity there. All right, let's take a look at the because of this move in RSP, you're actually getting a pretty decent move in breadth. So we are well above 35. We're up to 69 today. Yesterday we were up to 45. So we're getting a very good move in breadth, almost back above 500 here. If you look at the number of stocks trading above we'll look at this here in a second. Number of stocks trading above their 50-day moving average. Big jump back above 350, so that's 70%. Number of stocks above the 200-day moving average, big jump up above 380, so above the well above its moving average. So it's brought this ratio down, which is very bullish, but not below 1 yet. So we're still okay from that perspective. The number of new highs jumped up to extremes a few days ago. Here, let me zoom in so we can see that jump to extremes. So yesterday you can see we were actually below the average at 187, but the day before that we were up to 456. So a big extreme move. We typically peak at these extremes, but and you can see the new lows also down, and that gap between those two made the new highs and new lows index jump up to an extreme level. So, and the average jumping up. So really good, like explosion of breadth here. Even your breadth thrust indicator, which this is the number of advancers relative to total advance and decline, the total issues in the New York Stock Exchange, is up 2 days ago. So the last day on this is the 25th. I guess it takes a while for this to update. So this would be on Monday. It's up to 60%. I mean, again, that's a pretty extreme mark. When you're a 50% member is more advancers than decliners, so 60% is a pretty strong number there for that exchange. So pretty decent breadth. But interestingly enough, the skew has really jumped up too. So this is yesterday's skew. The day before, when you look at the day before, we were actually up to 161. So right there, 161 on Monday. Yesterday up to 167. Again, a very high level for the skew. Extreme. 150 is an extreme. Generally, 150 is an extreme. We've been so high here this past. Let me show you. You can see why when I say that, it doesn't look like it on the past year, but if you look at it in the past 10 years, 150 is an extreme. In 2021 it wasn't, and we saw what happened in 2022. The market was bracing itself at the very end of this rally. The market was bracing itself for 2022 there. You can see all these other instances. Very rare to get above 150. Now the market is bracing itself again, right, with protection at deep out of the demand for deep out of the money puts is extremely high right now, to the point where the whole average, the 20-day average, is above 150. That's how high. And in fact, it actually got up to 160 here earlier this year, or a few months ago. The 20-day average did. So a very strong move in the skew. The market anticipating something coming down the pipe here, even though the VIX is still fine. But the VVIX not able to really break below 90 and stay below 90 like you would expect during a good bullish trend. I mean, we've been bullish this whole intermediate rally. Here, if I were to go back to the VVIX, just to kind of show you here, and then let's pull this one up. We'll pull up the VVIX, and then we'll go like a 5-year chart and get rid of this one, the left scale. So typically during these intermediate rallies, we get below 90%, we stay, right? So there's that intermediate rally there. This is the intermediate rally here. So since we peaked in August and we started our bottom, on the S&P, so it'd be right here. Let me pull up this chart. So market forecast. Okay, since we bottomed on August the 5th, right? That's the low, that intermediate low point. This is when we started the intermediate rally that we're currently on. The VVIX, you can see, peaked there on August the 5th, the day of our low point at 173. This whole entire rally, we've been unable to get and stay below 90, right? Which is where we were, if you look at the rally before that, which started on April 19th as a low, and we went all the way through the middle of July. So if you look at April 19th, was right here. You can see on that intermediate rally, we got below 90 and stayed below 90 the whole time. The one before that, coming off of the Halloween low of 2023, we got below 90 and stayed below 90 for the majority of that time. Before that, again, the pullback brought the VVIX up. So this entire intermediate rally we've been on now, we've never gotten below 90. Only briefly here at the end have we been able to get below 90. So really interesting move, considering that this drop that we had in August was essentially just a normal pullback. I mean, yes, it got a little bit past the 5% mark, simply because of this really, this 1 day move right here. Like, we were barely above 5% on that day, on August the 2nd. We had that one big down day on Monday that got it to 8 point, but obviously you can see we rebounded very quickly off of that low point. So really that was a very typical, 5% type pullback there. And yet the market kind of looks at it like it was some type of correction, right? That we got above 90% and now we're unable to get below it on the next rally. So very interesting level. Again, it kind of goes to show that the market is expecting something, at least in the options market, is expecting something coming down the pipe that we don't know. And, that the market, obviously the stock market, isn't really too concerned with, because we just keep pushing and grinding up to the upside. So whatever that catalyst ends up being, obviously if everybody knew about it, they'd be pricing it in right now. But the market is concerned about a kind of a black swan type 2022 type move, because we're doing the same thing that we did in 2021 now, heading into the end of 2024. All right, let's take a look at the sector rotation here. And we'll look at today. Oops. It'll be yesterday, sorry. And we'll go 5-minute chart. Utilities, a big gainer yesterday. And on the other end, energy materials. Even though the dollar didn't really rally too much, energy materials, financials, industrials. So your kind of IWM type company, portion of the S&P, those are the sectors that are most correlated with the Russell, even though they're not small cap, but they are small cap relative to the mega cap names in XLK, XLY, and XLC. Which are all three of them lagging the market too. Really, the only sector that outperformed the market yesterday was utilities. Probably not the one sector that you want to outperform the market, right? We want to see XLK continue to outpace and push higher. And this is today, of course, but yesterday we were still barely above, but not pushing up. And then you look at the ratio of XLK to SPY, which we want to be bullish. Remains not bullish, right? And you can see today it's down, and we'll talk about that more tonight. But it has been, even yesterday was down. This is not what we want to see on a ratio that is so positively correlated with the S&P 500. That brings us to our trade idea, which happens to be in the XLK sector, is WDC. Look at the breakout we had yesterday. Again, you can see the market sentiment line. Closing yesterday, right at the market sentiment, just a little bit below it, just a little bit below the midpoint, obviously crossing through it here today. Now the strong near-term rally up to the upside. So at least dark green shading now. It was light green shading in the green line, but well above the moving average yesterday, 9%. Really good move up to the upside on WDC. You can see the strong weekly candle we're getting, strong bullish with the PPO starting to rise. Obviously 3 green arrows on its chart, well above the 30 and the 8 and 17 day are crossing the 30. In fact, a big break above the 200-day moving average, and a close above all these high points here that we've had here recently. Looking at the DMI. The DMI, you can see, well above 30 on the positive indicator, below 20 on the negative. That's what we like to see on that chart. For a breakout pattern, above 60 on the RSI, above 150. We were above 150 when we made the trade yesterday. We finished a little bit below it, but strong CCI as well. Looking at the Ichimoku cloud, starting a new trend, a weak trend yesterday, starting a weak trend. Now we are clearly at a weak trending level there. And then looking at your Bollinger Bands and the Keltner channels, we closed above the upper band yesterday, and we closed above the upper Keltner channel yesterday, and still above the upper Keltner channel, even with a little pullback. But this big shift to positive momentum with the bands already outside the Keltner channel. So good momentum to the upside. So what we did on it was to do a long call trade at the low 20 deltas. So selling the 77.5, buying the 75. That gives me about a 2-to-1 reward to risk ratio with this much flexibility, right? This is how much flexibility we have left on this trade in case, as you saw, that it doesn't immediately go up day after day. If it takes some time for it to continue up to that 77.5 level, as long as the max gain is inside of one standard deviation window, we're okay from that perspective. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your evening, everybody, and we'll see you all next time.